Welcome back to Smart Dollar Mindset, the channel where we talk about money, mindset, and building financial freedom through smart money habits and investing. Today, we're diving into a topic that almost everyone deals with, but few truly understand: credit cards. Credit cards are one of the most powerful financial tools in the world. When used wisely, they can help you build credit, earn rewards, and even protect you against fraud. But when used carelessly, they can become a financial nightmare, trapping people in years of debt. So, what exactly is a credit card? How does it really work? And how can you make sure you're using it as a tool to build wealth, instead of a weapon that destroys your finances? By the end of this video, you will know everything you need to confidently use a credit card the smart way. We're talking about what they are, how they work behind the scenes, the pros and cons, different types of cards, and strategies to use them without falling into the debt trap. If you've ever wondered why some people swear by credit cards while others warn against them, this is the video you need to watch. Let's get started. What is a credit card? At its core, a credit card is a short-term loan offered by a bank or financial institution. Instead of paying with your own money like you do with a debit card, you're borrowing the bank's money, with the agreement that you'll pay it back. When you swipe your card, tap it, or enter the number online, the bank approves the transaction and pays the merchant for you. Then, you owe the bank. But here's where people get into trouble. Many see a credit card as free money, when in reality, it's a financial responsibility. If you don't pay that money back in full by the due date, the bank will charge you interest, and credit card interest is some of the highest you'll ever see. Key features of a credit card. Credit limit, the maximum amount you can borrow. For example, if your limit is $5,000, you can't spend more than that without a penalty. Billing cycle, a 28 to 31 day period where your charges accumulate. Statement balance, the total you owe at the end of that cycle. Payment due date, usually 21 to 25 days after your statement closes. APR, annual percentage rate, the interest rate charged if you don't pay in full. Most cards range between 18 to 30%. Minimum payment, the smallest amount you can pay to avoid late fees, usually around 2 to 3% of your balance. Real life example. Imagine you have a $1,000 credit limit and you spend $800 this month. Your statement arrives, and it says you owe $800. If you pay the full $800 before the due date, you pay zero interest. But if you only pay the $25 minimum, the remaining $775 starts accruing interest at, say, 20% April. Over time, that $800 could cost you over $1,200 if you stick to minimum payments. How does a credit card work behind the scenes? The credit card system operates on a revolving credit model. Here's the process step by step. Purchase, you swipe your card or pay online. Authorization, the merchant sends a request to the card network, Visa, MasterCard, etc. Approval, your bank checks if you have available credit and approves the transaction. Settlement, the bank pays the merchant, minus processing fees. You owe the bank. At the end of the cycle, you must pay your bill. Grace period. Most cards offer a grace period, usually around 21 days, where you can pay off your balance without interest. But the moment you carry a balance into the next month, you lose this grace period, and interest starts accruing immediately on new purchases. The compounding interest trap. Credit card interest is compounded daily. That means interest is added to your balance every day, and then you start paying interest on interest. This is why people who only make minimum payments often stay in debt for years. Example, the $2,000 vacation. You take a $2,000 vacation and charge it to your credit card. You decide to pay $50 per month. At a 20% APR, it will take you over 5 years to pay it off, and you'll end up spending more than $1,200 in interest. That $2,000 trip now costs $3,200. Types of credit cards. Credit cards aren't one size fits all. Here are the main types you should know. Standard credit cards, simple cards with no rewards, often low or no annual fee. Rewards credit cards, offer cash back, travel points, or miles. Secured credit cards require a deposit, great for building or repairing credit. Charge cards, no preset spending limit, but must be paid in full monthly. Balance transfer cards offer 0% introductory APR for moving high interest debt. Business credit cards, designed for business expenses, with higher limits and perks. Benefits of credit cards: build credit history. Responsible use boosts your credit score. Rewards and cash back, earn points, miles, or cash on purchases. Fraud protection, better than debit cards because the money isn't directly taken from your account. Convenience, no need to carry large amounts of cash. Emergency access, credit can help in unexpected situations. Risks and pitfalls: high interest rates, average APR is around 20%, much higher than most loans. Debt spiral, carrying balances month after month can lead to years of payments. Overspending, easy access to credit can lead to financial disaster. How to use credit cards wisely: pay in full every month, avoid interest completely. Keep utilization low, use less than 30% of your limit for a strong credit score. Avoid cash advances, they come with immediate fees and high interest. Choose the right card, match rewards to your lifestyle. Track your spending, credit cards make it easy to overspend, so stay on top of it. Advanced strategies: travel hacking, use rewards for free flights and hotels. Sign-up bonuses, many cards offer $200 $1,000 bonuses for hitting spending goals. Stack rewards, combine credit card perks with apps for maximum savings. Final thoughts: credit cards are neither good nor bad, they're tools. Like any tool, they can help you build something amazing or cause destruction. The difference comes down to how you use them. If you understand the rules, credit cards can work in your favor. They can help you build credit, earn rewards, and protect your money. They can be part of a strategy to achieve financial freedom. But if you misuse them, they can lead to years of stress, thousands in interest, and even bankruptcy. The smartest way to handle credit cards is simple: always pay in full, avoid unnecessary debt, and use credit for convenience, not as a source of money you don't have. Combine that with a strong financial foundation, budgeting, saving, and investing, and you'll never fear credit cards again. Credit cards should never control your life. Instead, they should be part of your plan to control your financial future. If this video helped you understand credit cards better, make sure to subscribe to Smart Dollar Mindset for more financial tips, strategies, and tools to help you build wealth and achieve true financial independence. Like this video, share it with someone who needs this knowledge, and check out our other content on smart money habits and investing.